Hi, guys. A very good evening to all our viewers on Money Control. This is Markets Weekly, and I'm Karunya Rao, as always, bringing you the wrap on the markets, key events that transpired in the week on by, and the important themes, trends, and sectors to watch out for in the next few weeks. Joining me today in conversation is Mr. Ajay Garg, the Managing Director at Equirus. Ajay, thank you so much for taking time out and talking to us today.
Thanks, Karunya.
Well,
It's always a
Ajay,
pleasure
first
to be on a
things
show like yours. Yeah.
always a pleasure to get insights from someone like you, Ajay. But given how the markets have been behaving, if you look at despite all the volatility, both Sensex and Nifty continue to be close to 9% off from their all-time highs. But if we keep in mind the fact that a lot of retail investors have lost a significant part of their investments, a significant part of their hard-earned money, what would you tell them? How should they position themselves in a market like this? What should be their strategy?
So, Karunya, I think our approach has always been sector and stock specific. Uh, in this, even in the current last few months, if you notice, there will be certain stocks which have obviously gone down, and certain stocks which have gone up. So the advice which we are giving to most of our investors and what we are also following in our PMS and other strategies which we employ is that we are looking at business by business, which businesses will be weakened in the next few quarters and few years, and getting out of those businesses. And there are certain businesses which will become stronger, and we're getting into those businesses. I think that's the approach we're taking on in almost every situation we're doing here.
So, for investors who are new to the market, should they be worried about what's happening? How should they deal with volatility in particular?
So I think what we do advise to most investors when we are looking at wealth and those situation, obviously, you do investing in the market from a trading perspective and an investment perspective. We always advise most of our work which you do is around investment basis. So it's a function of how you allocate your capital. If you're allocating your capital vis-a-vis equity and fixed income, and you do it from a long-term perspective point of view, focus on that. Markets will keep, there will be volatility in the market. There will be keep something, you'll see sometimes it going up, sometimes it's going down. But as long as you are consistent with your allocation, that's what you need to focus on, rather than worrying about volatility in the immediate, in the near term, because you cannot necessarily time the bottoms and the tops in the market.
A lot of our viewers are retail investors, and this show is dedicated to helping them understand what's happening in the markets better and to help them navigate and empower them to be able to take the calls in a more informed way. If we look at one big event of the week gone by, it is the commentary coming in from central banks. Fed has already tightened its liquidity. We all got some clarity from the Bank of England as well. Just to put things in perspective, Ajay, can you tell our viewers how do central banks commentaries impact markets, especially a market like ours, which is still a nascent market, an emerging market, as we all call it?
So, okay, there are two commentaries here. One is in terms of uh, any rise in interest rate globally does theoretically impact flows to the equities market. At the same point in time, when we look at the Indian markets, it's a variable which we don't see impacting a lot. But yes, in general, whenever interest rate rises, the belief is that the flows to equity market will go down. And I think what you have seen in terms of prices, it's a function of demand supply. So if there are less money coming in, then theoretically prices will come down.
So should they be worried? I mean, with whatever
No,
is
I think
happening?
from Indian market point of view, not really too worried about that data point at all.
Ajay, one very interesting trend that we've all seen, or an outshiner that we've spotted, is IT index. Can you tell us what is happening there? Because, I mean, whatever is going on in the broader markets, on the benchmark indices, banking stocks, IT index has been able to outperform, and quite impressively so.
So, Karunya, if you sort of started seeing this, and this is something which started in, a year and a half back when the people were trying to cope from this whole COVID impact, there's been a significant, investments have movement towards automation, digitization, making business work in a more non-physical format. And I think there were obviously companies who were there were obviously many types of companies. Some companies who were way ahead in their digital in the digitization and automation
Yeah.
spend. There were few companies who were getting there, but now it's become an imperative because physical contact and working in a physical sales and all is becoming more and more difficult, given what has happened in the continuous lockdown and other scenarios. So everyone has to work in a virtual situation. So that's where the investments in IT and IT systems is going across the board. Whichever businesses have to be relevant in this space have to have the best of the digital and IT systems, and that is sort of driving the numbers for most IT players. On top of that, you also seen that the rupee is also becoming weaker. So whenever the dollar becomes stronger, also that also improves the earnings at the IT company level. So I think given those two data points, you're not surprised to see the way the IT index is behaving.
If we look at the big trends of the year gone by, 2021, one cannot help but talk about the primary markets, the immense amount of action that we've seen in the IPOs. But off late, it has mellowed down a bit. It has tempered a bit. Do you think the retail investor is more empowered and is more seasoned now than he was at the start of the year and is weighing his options when it comes to investing in the IPO instead of just jumping onto the frenzy?
Now, I think we have seen a much large, we have never seen this type of maturity, both in the retail, HNI, and the investor community when it comes to ECM and capital market transactions, as we have seen in the last 12 months. There are, even in this environment, yeah, you have few instances of where IPOs are getting phenomenal subscription, but you also have few instances where, despite having some of the best backers for the stocks, we have not seen the type of impact investor interest which should be there when a typical bull market is. So there is obviously a serious discerning behavior being demonstrated by institutional retail and HNI investors when you look at subscriptions of some of the large IPOs also. So given that data point, I think they are there is a good level of maturity being demonstrated. At the same point of time, the type of companies that are coming in are also an unprecedented level of types of companies. So we have, last time when we saw such a bull market was in 2007, 2008, where you had everything and anything was getting sold. Since then, we have had muted capital market activities in small spurts. But one of the things which had happened in the last 12, 13 years has been that the private equity investment of close to 25, $30 billion every year has happened in building out the, what I call emerging growth sectors, or, new age companies and all those data points. And if you sort of cumulatively look at those 12, 13 years of private equity investment, which has kept faith in the India growth story, we took up a cumulatively 350, $400 billion of private equity capital, which has made some very interesting companies out here. So the type of companies you are seeing, whether they are in the digital space, new brands, retail, technology, fashion. So the type of companies that are coming out are, the capital markets have never seen this type of companies in the past. So I would still
Hmm.
believe that, and there's far more pipeline out there. So I still think that the quality of companies are still very attractive. Markets are showing a maturity around pricing. So I believe that there will be still opportunities to be made out there. Yes, whenever there is IPO which sort of seems expensive, then the market is giving its own reaction. But otherwise, we are seeing a great amount of capital market activity. We have never been as busy ever in the last 12 months as we are now.
Right. Yeah, a lot of our viewers are also sending in their questions and queries. Ajay, let's address one of them since we're talking about the big themes of 2021. Metals definitely hogged a fair amount of limelight, and one of our viewers is asking your outlook on metal, whether it's steel, whether it's copper, refractory stocks, so on and so forth. What is Equirus's stance when it comes to the metal space?
So we still continue to remain positive on that sector. But
Okay.
the type of run up which one has seen in the sector, I don't expect the same type of run up happening. But there's been definitely continue to be a good momentum out there. So we continue to remain positive in that sector.
Okay, but any favorites you have, whether it's ferrous, non-ferrous, refractory stocks, like our viewer was also pointing out?
I would not be able to sort of have a very specific on that one, Karunya.
Okay, okay. Well, some more questions are trickling in. How do you see the upcoming budget and what could be the impact on the markets? Typically, if you help us do some trend spotting, how do the markets tend to behave in the run up to budget? Of course, in the rest of the year after the budget, we've always seen benchmark indices do close with a gain. The entire month also typically does well in the month of February. But in the run up to budget, what should investors expect? How would the markets behave in your view?
So I think to a large extent, what needs to be seen is in terms of how government gives a direction to the fiscal deficit. We did see that the government did have a long spending budget, which got delayed in execution because of how the second lockdown and the second wave of which happened in the month of April, May did delay things. But there is still a clear fiscal deficit which one continues to run, and we continue to see as to how government continues to sort of make the investments required to keep moving the economy at the growth rate which we are anticipating. So one will have to see the fiscal deficit number, and I'm obviously of the view that there will be a still, given the way the RBI also came in last earlier this month, that there continues to be a bias towards growth, and if that continues, we will definitely look forward to the momentum continuing.
Okay, well said. Our viewers also sending some questions on FII selling. How big a concern is that for the markets? While yes, we have seen a record amount of inflow when it comes to domestic investors, but FII selling also has been a bit of a pain point for the overall market mood.
So I think there is good news and bad news in that data point. The bad news obviously is that the FII amount is coming down, but the good news is that if one looks at India's allocation, FIIs obviously comes from a basket of Asia Pacific, and they have an allocation across various markets in Asia Pacific. So if you look at where the data was in August 20, you had China was at around 41-42% of the Asia Pacific market in FII's basket, and India was more like around 9%. Today, China is down to 31% and India is around 17%. But yes, there has also been a, given whatever has happened in China and the regulatory impetus, and you have seen concentrated policy action around some of those digital stocks and the US market reactions and all this stuff. So there's obviously been some reduction in allocation because of it. India has also got impacted. But India's allocation per se has improved dramatically in the Asia Pacific. I think now it's almost a number two country ahead of Korea and Taiwan, which was not the case earlier on. So I think if I look at the FII data in this context, I think India's weight improving, and where India is poised today, I am sort of seeing much stronger flows in the next few years, specifically after LIC and around LIC, as India weight also improves dramatically and allocation comes back to the region.
How do you see the LIC listing, affecting or rather impacting the overall insurance basket, the listed insurance universe that right now we have in the Indian markets? Do you see it drastically change the game, change the valuation game as well, perhaps, for insurance companies?
See, this is the first time at a company which will be at such a scale and size getting listed in India, and it dramatically, if you look at the total market cap of the country, we are talking about 250 lakh crores, and LIC itself, from the valuations which have been talked about, will be 4-5% of the market. We've never seen in a situation of such large coming in. So obviously, as the market cap depth improves, liquidity and depth improves, allocation also improves. So I see this from a context of a game changer. I written an article also last year back that if you compare to what happened to China Life, which did the IPO in 2003, and the impact that data point had in the China market and overseas allocation from 2003 to 2007, if the same thing happens in the Indian market, I'm a big buyer in the Indian stock today.
I was just going to ask you about your sectoral picks for the fresh year. But one of our viewers is also asking us, apart from IT, which sectors of the economy are likely to see good earnings growth? Apart from IT, of course, being an obvious candidate. Which where else can you see good earnings growth coming in for the next 1 year odd?
See, earnings growth is going to be almost, I think every sector will show good earnings growth because of, the base effect of COVID numbers in FY21 are what they are, that. So if you look at it, and I think we have seen the COVID impacting even this first quarter of FY22 and the second quarter also. So whatever next 6 quarters you see, you will definitely see good growth compared to quarter on quarter basis. Uh, Having said that, I would be definitely looking at which are the sectors where there's going to be good growth momentum, because we have heard even Mr. Birla talk about mahotsav of capex, private investment,
Hmm.
capital good stocks. We would continue to remain bullish on that. We have not seen, I think, after a very strong equity market like the way it was for the last 2 years now. Uh, we expect, the way generally the behavior we have seen in the past also, the real estate sector follows thereafter. You'll start seeing, allocation to real estate, specifically given the benign interest rate scenario. We are already seeing that stocks also moving up in that sector. So those are the two sectors we will definitely look out for: capital goods and real estate.
We're clearly seeing a lot of questions trickling in for IT specific, investments. One of the viewers has said that auto, FMCG, metals, banks, all of them look like they're in the grip of the bears. Should one move their money and allocate all the capital to IT sector? And if yes, should they look at large caps or mid cap IT stocks? Do you have a view on this? Is this a good
So,
time to reallocate your positions?
so I personally feel that, that, see, there's one data point which I sort of discuss internally also a lot. Like before COVID, we were around 150 lakh crore market cap. Okay, today we are at 280 lakh crore, 290 lakh crore market cap, which is a 140 lakh crore market cap, improving in the last 2 years. 35% of that is held by retail HNI investors directly or through mutual funds. So that's a 40 lakh crore balance sheet improvement of your audience, and thereabout. That's a huge number in the context of the size of the economy. I think the consumption stocks also, which I think the data point being discussed is that there's a bear situation. I've still to see that ripple effect of that consumption to play out, and I'm very bullish on that segment also. Yes, there will be technical volatility, but I'm not going to rush into changing allocations based on the data points right now.
Okay, fair point. Fair point. But what about sectors that you still think are yet to come out of the woods, which perhaps are a no-no for you at this point, or for perhaps for the next few months, that investors should also be a bit wary of or a bit cautious of?
Again, sectors which have run up far ahead means, like, you have seen chemicals do very well over the last so many years. So now we'll obviously wait for the multiples to be reasonable. So I look at those sectors from that perspective. Rest everywhere else, I'm sort of, I don't have a view negative on anything which I talked about. I think
Ajay,
it's more about relative price to where the earnings could be. Yeah.
we get a lot of queries from our investors about what they should do now, because a month back the queries were on the lines of whether we should book profits, but now the tone has changed, the narrative and the questions have changed. So now it's more on the lines of how do we protect our profits or cap our losses. A large chunk of these investors obviously are the ones who entered the markets last year or fairly recently. So what will be your advice to them? How should they sort of what should they do right now?
See, it's very difficult. Again, it's sort of the advice which you always keep getting. It's very difficult to time the market. Uh, when we had the weakest market was March 20, but nobody could anticipate the rally. And by the time people anticipate the rally, the stocks had all gone up by June, July, August. When people started participating, the market stocks have gone up. So the advice has always been time in the market rather than timing the market. Uh, Stick to your allocation, which should be a proportion of equity and fixed income depending upon your age profile. You keep varying, whether you are 50-50, 65-35, depending upon that's the situation, and you stick to the allocation and remain there, rather than trying to sort of at every news and data point try to figure out whether we get the best timing. Is a general advice I would give, and that's what I follow personally.
So for 2022, what are some risks and some developments perhaps that you will be watching out for, or even themes that you will be watching out for closely from an investment standpoint?
So I think clearly you are India obviously has a large country, and you have a lot of data points which keeps coming in. So some of it would be in terms of how we deal with inflation, how we deal with the subsequent impact of that one, how fiscal deficit gets played out. Uh, we also have seen a lot of aggression across the border, and we would obviously want to keep watching that too, in terms of seeing whether it escalates at any given level. Those are the two risks I look from a domestic perspective, and globally, what you highlighted in terms of whether the tapering off effect, which is I think every Western country is talking about, is it orderly, or it will be sort of cause more impact of volatility. So I think those are the 2-3 data points when we look at.
Okay. Do you or your team have a target that you'd like to share for 2022? What will be the level to watch out for benchmark?
So I personally don't see the benchmarks going up a lot. It will be range bound, because as the valuation's already gone up and earnings catches up, so there will be a little bit of multiple tapering off, but prices may remain pretty much the same level. But yeah, our team very rarely looks at the benchmark. We are very focused on bottoms up stock picking. Yeah.
Okay, perfect. On that note, Ajay, I'd like to thank you once again for taking time out talking to us and for addressing our viewers' questions and concerns and queries as well. We wish you all a very happy and prosperous new year from all of us at Moneycontrol.
Thanks, Karunya, and thanks for having me on the show.